welcome everyone. My name is Margaret Wheeler. I'm the president and CEO of the Executives Club of Chicago. It is my pleasure to welcome you to today's annual Economic Outlook, a time-honored tradition for over 40 years. This is our largest and most anticipated event every year, and I'd like to take a moment to not only virtually welcome you, but thank you so much for all of your support of the Executives Club of Chicago. If this is your first time at an Exec Club event, thank you for being here, and we'd love to welcome you to our community by becoming a member and joining one of our upcoming programs. While, of course, we all wish that we could be gathered today in person, we're thrilled that you can tune in for today's discussion. Everyone pivoted quickly, as we're all very used to doing today. And on behalf of all of us, thank you for all of your flexibility and understanding. Before we get started, I want to thank all of the sponsors that make programming at the club possible. Special thanks to today's presenting sponsor, BMO Harris. Thank you to our AEO featured sponsors, Baker McKenzie, Barilla, CDW, Chicago Cubs, CIBC, Discover, Duchess Swonk, Healthcare Services Corporation, Ingredion, JLL, Molex, Northern Trust, Northwestern Medicine, OCC, PNC Bank, PwC, Robinson Resource Group, US Bank, US Cellular, and Victory Park Capital, as well as our AEO supporting sponsors, Associated Bank, Protiviti, Wells Fargo, and Winston & Strawn. We have so much to cover today, so without further ado, I'd like to introduce Mike Stritch, Chief Investment Officer for BMO US Wealth Management, to say a few words and to introduce our moderator. Over to you, Mike.
Thank you for the introduction, Margaret, and welcome everyone to the Annual Economic Outlook for 2022. I too had hoped we would be back in person this year, but no, we'll still have another lively virtual discussion as we did in 2021. As Margaret mentioned, I'm Mike Stritch, Chief Investment Officer at BMO Wealth Management, and BMO is proud to be the presenting sponsor of today's program, a long-standing tradition for Executive Club members going back many decades. At BMO, of course, we also stand behind the Executive Club's mission to bring together a diverse group of business, civic, and academic leaders to discuss issues and opportunities in our great city and beyond. When we last met in January of 2021, I recall a discussion that instilled much confidence and optimism after an incredibly challenging year. At that session, I gave the closing remarks and remember taking great pride in panelists' comments referencing the incredible resiliency of our nation. I now look forward to hearing where we have landed 1 year later and what predictions will be made for the coming months. I certainly have no doubt that Terry has her trusted chart ready, detailing all of the forecasts from last year. And with that, I'm thrilled to introduce our moderator today, Terry Savage, who's played this memorable role for many years. I know everyone looks forward to her insights, her perspectives, and of course, her tremendous enthusiasm. Terry is a nationally recognized expert on personal finance, the economy, and markets. She writes a weekly column that's syndicated nationally by Chicago Tribune Content Agency, and is the author of 4 best-selling books on personal finance. Terry appears frequently on national television and radio programs, commenting on the financial markets and current economic events. And here in Chicago, she's featured on WGN Radio and WGN TV with her weekly segment on personal finance. And with that, thanks again for joining us. Terry, over to you.
Oh, thank you so much, Mike. Thank you very much, and thanks to BMO for doing this every year. What can I say? We did it. We're here again. We are not transitory. That's the one thing about us. We are back for more, and it is so wonderful to see all of you back for more. I know you're out there. I know more than 1,500 of you are out there, and that's tribute to our wonderful speakers and our new guests this year, as a matter of fact. So let me just say that I'm joined in this year's version of Hollywood Economic Squares by our good friend Diane Swonk, Chief Economist of Grant Thornton, Dr. Bob Froehlich, who is our prognosticator extraordinaire, and this year our special guest, John Rogers, founder and co-CEO of Ariel Capital Management. Welcome all of you, and welcome to our audience. Let me give us a little background before we get to your forecasts and then the much awaited Q&A. So let's give a little bit of perspective. I was thinking about what to say this year. I look back at my notes. You know, a year ago, Facebook was Facebook. And now Facebook is a metaverse, which I think is a place where real people turn real money into crypto money to buy fake stuff. Well, they don't buy it. They're avatars who are fake people buy fake stuff like Nike shoes and a house next to Snoop Dogg, which is really valuable real estate in a kind of a fake world. That's where we are today, trying to predict economic forecasts. So for sure, I think that your jobs are even tougher because you not only have to predict for the real world, but the fake world. A year ago, who knew what an NFT was? A non-fungible token. But in March, just after we had our forecast luncheon, the artist Beeple sold a digital NFT for $69 million at Christie's. And by year end, the artist Pack sold another NFT, The Merge, for $91.8 million. And you know, you can't even put that on the wall. A year ago in January, the meme stock craze began. In just a few days, remember after our meeting, that whole GameStop thing, it was a retail store, that stock soared 400% as the amateurs squeezed the shorts. That wasn't the end of it. Just last week, GameStop announced that they were entering into the NFT and crypto world. So this marketplace is very different. Remember last year at the center of all was Robinhood? Well, Robinhood almost imploded under this whole GameStop thing and a bunch of other meme stocks. Yet barely 6 months later, Robinhood managed to go public in late July and quickly traded as high as $85 a share. Today, it's trading around $16 a share. So maybe one cause of all this was all that money, another $1.9 trillion put into the economy as part of the third stimulus program, $1,400 per person and dependent, that came in March. So let's take a look at the numbers. A year ago, the Dow Jones Industrial Average, as we met, was trading at 31,060. Last night, it was 36,290. That's about where we're trading right now. And although we mark our predictions from luncheon to luncheon in mid-January, it is worth noting that the Dow was up 18.73% for all of 2021. Now, we've always used the Dow as a measure of the stock market because it's the most well-known number. But this year, we probably need to include another one. So I'm going to put up a chart of the S&P 500. It's a much broader based index that is really, it outperformed the Dow this year. Past year, it was up 28.7% last year, 2021 versus 18.7 for the Dow. And it closed last night at 47.26. But what you're seeing here is a 13-year chart of the S&P 500, which just really says a lot, courtesy of market analyst Ron Sears. He pointed out in the past 13 years, the S&P 500 has returned 600%. Everybody's so worried about beating the market. As I've always said, you'll do fine just being the market. In fact, this probably is something someone should tell Kathy Wood, stock market guru, whose ARK Innovation Fund fell 48% from its high about the time we were meeting last year of 159 to a low of 80 last week. Let's throw up the slide of the NASDAQ. The NASDAQ, that was the scene of a lot of volatility. Last year when we met, it was trading at 13,129. It reached a high in the fall of 16,212 and then suffered a big sell-off lately, rebounding a little bit, but closing now just above 15,188 last night. So before we get our experts, we're going to have to talk to you about your predictions, up or down for the coming year. Last year, 70% of you were bullish on the Dow Jones Industrial Average. So let's put the polling slide up and let me ask you again, your stock market forecast for 2022. Well, I'm going to make it easy for you. We're going to have above 40,000, about where we are now, between 36 and 40,000. That's like about unchanged, or under 36,000. So let's see what your forecasts say. Well, this is very interesting, actually, as your votes come in. Okay, you're all capping out on me. I'm going to have to write this down, by the way. I would say that over 50% are unchanged is the option, and about a small percentage up and even less down. Okay, I'm just writing this down so next year I could remind you of what you did. All right, let's move on. to the next slide is a 10-year Treasury note. Interest rates are no longer boring. They have stopped being boring a couple of months ago as inflation soared, but you think that maybe something better would happen. Last year, the 10-year Treasury note on which mortgage rates are based was yielding 1.09%. Yields have jumped in the past few days, jumping to 1.8% a few days ago when the Fed acknowledged, yep, we're going to have to raise rates probably a bunch of times. But think about this, even after yesterday's inflation news, we don't see interest rates soaring. And last night, the 10-year yielded 1.73%. And of course, that's, as I said, the rate that influences mortgage rates. Those have been rising. So let's get your take and do another poll on interest rates for 2022. And I'm going to make it easy. With the 10-year Treasury note yielding 1.73%, do you think rates will be higher next year or lower? Is thumbs up or thumbs down? Oh, look at that. Well, maybe only 12 people have voted. Wait a minute, a few people think they'll be lower. Okay, the vast majority says, like 99% say higher. Okay. All right, well, let's move on to inflation. And it's really good to have some perspective on this. The word transitory is, as we said, out of fashion now. Inflation has been building. Let's move forward to the inflation side. I thought you'd like this inflation chart. Last night we had that 7% year over year print, a 32-year high in inflation. But you're going to like this chart because the blue line is that monthly CPI for all urban consumers. But just in case you're one of the few out there who doesn't use food or energy, you can be a little happier. The red line represents you. Yes, without food or energy, inflation is somewhat more moderate. So let's take another poll. What do you think will happen in 2022? Will inflation moderate or will it move higher? And I'm going to give you a stroke on this one. It's 7% year over year last night. And this is no error. I said, will it be higher than 6% for all of 22 or in December 2022? Or will it be lower than 6%? So this is a tough one. I'm already giving you 1% lead off. And I like to see these numbers come in. I really want to keep these. It's looking like, I feel like at the Bears game, when they say Cuppy Cup is coming out of the turn and the donut is catching up, it looks like we are about evenly split on inflation. At least half of you think it will be lower than 6%, and we're already at 7%. Okay, let's keep track. It's interesting that inflation has soared, but the price of gold, last year I put up the chart of gold. I'm not putting it up anymore. It's boring. It was $18.55 this time last year. Today it's trading about $18.20, even after a couple of 3 months of high inflation. So my question to you is, do you think Bitcoin is maybe a better hedge against inflation? We asked that last year. So here's the chart of Bitcoin. We're going to poll in a minute. Last year at our meeting, Bitcoin was trading at 36,207. Right now, just a few minutes ago, let's call it 44,000. But beware of averages. You know what they say about the guy who's standing with 1 foot in a bucket of boiling water and 1 foot in a bucket of ice water. On average, I feel fine. That's kind of what the average of Bitcoin prices this year was. We reached a trading low of just over 30,000 in mid-May last year in 2021, and a high of 68,000 in November, just a couple of months ago. So we've had a lot of volatility in Bitcoin, and I want to do another poll. Last year, only 25% of you said that Bitcoin would be higher at the end of the year. It is higher. It's been lots higher. It's also been lower. So let's put up a poll for 2022. Do you think Bitcoin will be higher than today's 44,000? Or do you think it will be lower than 44,000? Can we start that poll? I'm just looking to see if, here we go. Okay. All right. Oh, okay. Higher. Everybody's saying higher. Wait a minute. Higher. 2 to 1 higher is what I'm saying. 2 to 1 say higher. I should have put up a poll calling, would you buy Bitcoin? Have you bought Bitcoin? Very interesting. Okay, well, with all of that said, now our panelists know what you think. It's time to hear what they think about some key topics. So in their presentations or afterwards, I'll nudge them to give us a prediction for the Dow Jones Industrial Average, the NASDAQ, interest rates on the 10-year Treasury. We'll ask them to talk about unemployment and inflation. Maybe they'll give us gold or Bitcoin forecast. Plus, my favorite question that always begins with it comes at the end of the questions, what they would do with $100,000 in risk capital to invest for the year 2022. And start with Diane Swonk, our first forecaster. Diane has been our longtime panelist and good friend. You see her regularly on CNN and other news programs talking about what's happening in the economy. Diane is chief economist and member of the executive leadership team at Grant Thornton. She's a labor economist by training, so how perfect for some comments today. She frequently advises the Federal Reserve Board, the Chamber of Commerce. In fact, I've stopped reading Diane's whole bio. We're both getting to the point where it's embarrassingly long and takes up a lot of time. But I will say that Diane's first appearances on this economic forecast luncheon started when she was chief economist at the old First Chicago. And if you're not young enough not to know what that was, someone next to you will tell you. Last year, Diane's appealing humanity as an economist and as a person was on full display here. She expressed her concern for the labor force impacted by COVID. Remember, we were all just about to get vaccinations. And she hoped we were on the last mile to herd immunity. Little did we know how treacherous that mile would be, with both Delta and Omicron and vax doubters slowing the path. And I'd like to add here on a personal note that Diane, clearly looking wonderful here today, successfully dealt with her own health issues revealed at the end of last year's program. So great to have her strong voice back this year. So as I said, last year, Diane was optimistic about the economy. And you saw that in the sizzle reel that we played at the beginning. She said, however, that the Dow would only reach about 28,000. That was up a bit anyway from last year's performance, and the Treasury yields would remain at about 1.3%. But she did predict quite correctly that inflation would show up at the end of the year. So let us for sure welcome back Diane Swonk to be our first speaker at this year's forecast. And let's remind you that if you have questions during the program, put them in the chat box and we'll try to get to them after our three speakers. Diane, I turn it over to you.
Thank you, Terry. And 11 surgeries, 11 surgical procedures, multiple cancers. I'm the epitome of Build Back Better because it's the only one you're going to get this year. So in 2 years, March 12th, 2020 was my first surgery. So I am very, very happy to be here, even though I'm not here. I would love to be in person next year. So anyways, yes, my health is much better. For the moment, I am cancers multiple free. So Omicron, really underscores one truism about the U.S. economy, and that is that the health of the economy is ultimately dependent on the health of the population. We saw fear of contagion and aversion to in-person events like this right now, and acute labor shortages due to a surge in just the number of people out sick right now. It will easily cross a new record. One of my colleagues at ZipRecruiter has estimated some 5 million workers will say they're absent from work due to illness in the month of January. And unfortunately, the data, because it doesn't include all of the testing, doesn't include all those people who are sick and home and not able to get tested at the moment, it could be 5 to 10 times that. We've never seen anything like this. Those labor shortages are causing major closures and major disruptions. And in many ways, it's mimicking a mandated lockdown, even though it's not a lockdown, and it's much more messy and chaotic. It's more chaotic than we saw in March of 2020. And that's because what we're seeing is it hit essential services, everything from transportation. We've seen the thousands of flights that have been canceled, to trucking. Truckers are among the least vaccinated out there. Only about 30% of truckers are vaccinated. And as of January 15th, our border with Canada, which includes a lot of intra-industry trade, most notably in the auto sector, they're requiring in Canada that you have vaccinations to cross the border into Canada, which it's a logistical nightmare that we're facing. It's important to look at what's going on in terms of those disruptions, because they're also hitting even garbage collection, fire, police, emergency care, and of course our healthcare sector, which has already been hit with record quit rates, Nurses tend to be older on average than the rest of the population, than other workers in the population, many of them retiring for good. Excess retirements have soared over the last year, even as vaccinations came back. And what we're seeing is that this economic disruptions are much greater than they were during the Delta wave. The important thing, the silver lining, of course, is that Omicron descends almost as fast as it ascends, and that's the good news, is that it comes down as fast as it goes up, and we're starting to already see in the Northeast and Southeast cases beginning to come down rapidly. Of course, unfortunately, hospitalizations lag, and at the same time that we're only about 95% on hospital workers from February 2020 levels going into Omicron. We're at record hospitalizations, and unfortunately, record hospitalizations of children as well. It's important to look at this in terms of, we've been through this before, but we've never been through it in a synchronous way. The Delta wave hit different parts of the global economy at different times, starting in India and then spreading around the world. This spread of this has been so rapid that we're seeing it hit all of the global economy synchronously. And I think that's important to understand as well, because the disruptions we're feeling are also disruptions simultaneously abroad. Everyone from China is in lockdowns again, their zero tolerance policy, but Vietnam is seeing a new wave. India is seeing a new wave. We're seeing a new wave in both developing economies and the developed world. And I think that's important when we look at the Federal Reserve. For their part, they have now decided that variants are more inflationary than disinflationary. They've pivoted in record time from being patient on inflation to panicking on inflation, talking about reducing the size of their balance sheet by late spring when they're still increasing the size of their balance sheet at the moment. They're primed to raise rates in March of this year, even if we have a hard stop to the economy in the first quarter, which can't be ruled out, and that's important to remember. It's important to understand why they want to use their balance sheet along with rate hikes in terms of how they deal with the US economy. And that's because they see their balance sheet as reducing that, as amplifying the effect of rate hikes, so they don't have to do as many short-term rate hikes in 2022. This time, we thought it would be different. Pandemics have a long history of labor shortages and raising real wages adjusted for inflation because of the sheer number of people that they destroy and the lives they leave in their path. We thought the science would beat it this time, but we were wrong. It didn't. Fatalities worldwide are now on par with other pandemics when you include the excess deaths in developing economies where they were unable to count all of those people who perished in response to this pandemic. And we're not done yet. It's also important to remember that even pockets of the United States had excess deaths that did not go counted in hotspots, most notably in areas of low wage, people of color, communities of color at the beginning in the first couple of waves in the winter wave of where we were a year ago in 2021 and 2020. And during the Delta wave, more young people perished, which actually cut into our labor supply along with long COVID, which is a disability. This was unique in that the pandemics historically have never created inflation because they were so devastating to livelihoods as well. But this time it was different. It really was different, not on fatalities and not on our destruction of supply and disruptions to supply, but on our support for demand. Technology and the ability to work from home in our bubbles and move online to spend and buy everything we possibly could to ease the comfort of quarantines for those of us who could live in those bubbles. We saw spending soar. We also saw unprecedented emergency aid and stimulus, not all of it well targeted. I think the last round of stimulus checks went to more vehicle purchases than any in history. And it was poorly targeted, although badly needed. We didn't even spend all that we allocated by the government because the government isn't very efficient at spending. But the collision of demand soaring in a pandemic at the same time you've constrained supply was combustible. And that combustion was, of course, showing up in inflation. The US economy easily grew 5.7% in 2020 21. That's the strongest pace since 1984. And as Terry already noted, we've got 7% inflation in December, the hottest pace since 1982. This year, even if we have a hard stop and a contraction in the first quarter, I think we'll easily cross 3%, 3.5% for 2022. And I think what we're going to see is 3 rate hikes by the Fed, but then a reduction in their balance sheet as well. That's well above the pace of the 2.25% we saw pre-pandemic, the sluggish glacial economy that we saw out there. Inflation, it will slow over the course of the year. Some of it's just math as we get into the summer months and the spring. You can't go from negative April 2020 oil prices to positive $65 a barrel unless we go to $150 a barrel oil. You're not going to see that push on inflation come spring. But will inflation cool enough to not be hot to the touch? I don't see a Goldilocks economy out there. I think inflation, overall inflation, December of next year, we'll likely see around 2.5%, but core, that stripping out the food and energy, we're going to see a reversal on that, hotter than overall inflation, as most notably shelter costs accelerate throughout the course of the year and really bite into people's ability to spend. The Dow Jones Industrial Average, I don't like to forecast this, Terry always makes me do it, but I do. So 36,500, about where we are today. I'm not overly, we've got a market that's priced to perfection in a world that's wholly imperfect. In terms of where will the long bond be, the 10-year Treasury bond, you could have knocked me over with a feather that it went down to 52 basis points in the middle of the pandemic as we were allocating trillions of dollars in deficits. It turns out the bond market was more willing to absorb and buy that debt than risk the alternative of not stimulating demand as we did. And they've been really pretty happy with that. Past performance is not a good indicator of future performance. That is a reminder they always tell us. I'm looking at the long bond at closer to 2.5% by the end of 2022, because I think this will be highly destabilizing as the Fed reduces their balance sheet. It's very hard for the Fed to engineer soft landings in what is a glacially moving economy. It's even harder to get policy right and not do a misstep when for the first time since the 1980s, you're chasing instead of preempting a non-existent inflation. The risk is a boom-bust cycle that's amplified by the shift from just-in-time inventories to just-in-case inventories. I worry about that. I worry about what price we're going to pay on the other side of this as we get into 2023. But I can tell you this much. I'm hoping this year that the science doesn't get sidelined and that we lean into the science and get ourselves, history also tells us pandemics tend to last 2 to 3 years. So I'm really hopeful that a year from now, we'll move from a pandemic to an endemic. The Fed can't cure what ails us. The only thing that can cure what ails us is to escape the pandemic. A pandemic anywhere is a pandemic everywhere. And we need to vaccinate the world as well as us. And we need to be able to have treatments to make it more manageable to get into that endemic phase. My hope is a year from now, I will be standing in front of you in person. Hope springs eternal, as opposed to doing this virtually, and that the world will be a better place. Although we went through the looking glass, I don't think we can go back. We don't get to wake up like Alice did, but we do get to reflect on what we've learned. And there's a lot of information or challenges to turn it into knowledge. Thank you.
Wow, I can hear the applause ringing if we were sitting or standing on the podium in the ballroom. But I hope you can hear it too. I want to go back and just ask a question. We were talking simultaneously about the long bond and the 10-year. When you said 2.5% yield on the 10-year by year, we're talking about the 10-year. Lately, there hasn't been much.
10-year.
Yeah. Okay, on the 10-year. I'm going to say, you're so good at unemployment. So I'm just going to wait and save. I know there'll be a question. If there isn't, I'm going to make that my first question. In fact, I'll just preempt it and ask you when we come to the Q&A to talk about this very strange unemployment thing going on, okay? But thank you very much. I've got all your other forecasts, and of course, we'll be asking you, and I'm not letting you duck this year, about investments, okay, for next year. John Rogers is next up. And John, now you've of course, you sat on our dais for almost all these years, John. So this tradition is not new to you. But let me introduce John Rogers as our next speaker. And then after that, Dr. Bob. John joins us this year for the first time as our annual guest expert. I would just have to say it's about time. Many of you know John not only for his market expertise, but for his public service here in Chicago and nationally. You know, he served as co-chair for the Presidential Inaugural Committee in 2009, and most recently joined the Barack Obama Foundation's Board of Directors. I can't go through John's whole bio. He serves as vice chair of the Board of Trustees at the University of Chicago and been so involved in so many of our civic organizations. In corporate America, John serves on the board of directors of McDonald's, Nike, the New York Times Company, and Ryan Specialty Group Holdings, the insurance company. Let's go back to his investments, though. He founded Ariel Investments. It's a global value-based asset management firm. He founded the firm in 1983. I remember when. It is the first African-American owned asset management company in American history. His flagship Ariel Fund is the only mid-cap value fund in the US that dates back to 1986. The fund has beat the S&P 500 since its inception back in 1986, and just this past year returned 30.36%. I think, John, we got you on a year too late. We should have had you last year so you could have told us to buy your fund, which you'll probably do later when we ask you how to invest. We look forward to your comments about the economy, interest rates, the stock market, and obviously about where you're going to put $100,000 in the market today. And I just want to warn you, John, if you say, just tell us all to buy one of your funds, you're going to that would make it easier for all our guests to participate, but you'll have to let us know which are your favorite stocks in your portfolio. But first, your thoughts about the economy, what's going on in America today. Ladies and gentlemen, John Rogers.
Thanks so much. It's so great to be here with so many old friends, Diane, and of course you, Terry. We've been so good friends for such a long time. So it's again a pleasure to be here. You know, it is an extraordinary time. It's just like a time like I think none other, with all of the volatility, all the strangeness that's out there. It has been a scary year. I would start by saying, though, that the economy has been remarkably strong. You know, we know that when I talk to the portfolio companies that we own, you know, we every quarter we talk to the management teams of the 100 or so companies we own throughout our fund portfolio holdings. People are optimistic. They're bullish about the strength of the economy, and nothing seems to be slowing them down. And I know from the board work that I do, this economic strength just seems to be throughout our community, throughout our country. And so I'm very, very optimistic about being able to have GDP growth substantially better than expectations that are out there. Now, at the same time, as we see this great economy, the market itself, I still think, is very, very expensive. You know, on a historical basis, the S&P 500 is selling near all-time highs throughout the year, you know, making highs with a price earnings multiple of over 22 for next year's earnings, you know, discounting a lot of good news and a lot of economic strength. And similarly, you know, NASDAQ has been extraordinarily successful for quite a long time, as you touched on earlier. And it's just been a market that has gone up and up as these large cap growth stocks have boomed in a low interest rate environment, which has been so critical. You know, when you can buy a growth stock that's going to bring you earnings years in the future and have low interest rates, it makes those companies very, very valuable. And many of those large tech-oriented companies, of course, have made up a larger portion of the S&P 500. And there's another reason why that index is so high. So in this environment, though, is what we're finally starting to see. And, you know, my colleague, Charlie Bobrinsko, I hit you up and see talking about the high interest rates are going to be higher than expected this year because inflation is going to be higher than expected. This economic recovery, all the economic stimulus from the government, all these things are going to push inflation well beyond the 7% that we've been seeing. We think it'll surprise on the upside as we all see the shortages that are out there. We see the pressure on wage rates, pressure on commodities, and with inflation rates so much higher than expectations, interest rates, of course, will have to follow. And we've already touched on that. We know the Fed is finally getting rid of the term transitory that we didn't believe in. And we think that the 10-year could be over 3% next year. And so we think rates will be much, much higher. And that will cause, similar to what happened back in the turn of the century, when the internet bubble burst, the S&P 500 and the NASDAQ collapsed, and value-oriented stocks did extremely well, relatively speaking. We think that's going to happen. So we would not be surprised to see the Dow and the S&P both down over 10% this year. And the NASDAQ could be down another 15% or so this year. We think, again, the Russell 2500, sort of the small, mid-cap value stocks, we wouldn't be surprised to see them more than hold their own and recover with a plus 10%. As we know, value's been out of favor for so long. We've been in the doghouse forever. Everyone's made such easy money in large cap growth stocks. We think that's where the damage is going to be and the pain will be. Now, when you talked about Bitcoin, we do believe Bitcoin is another kind of tulip bubble, and we think there's no real value there. It's not a store of value. It's not a currency. The volatility you see in Bitcoin makes it very difficult for it to, we think, survive in this current fashion. So we wouldn't be surprised to see this decline. I know Bitcoin has a very volatile year, as you showed in your charts, but I would think sometime, you never know what's going to be exactly within 12 months, but I know that's part of the job here today. I wouldn't be surprised to see Bitcoin down 30 to 40% this year, have a pretty dramatic decline. And then finally, I do think Omicron is the last of this COVID crisis, and we think it's going to bring herd immunity along with all the vaccines. So I know we'll talk about this later, but I would not bet against this recovery. And I would be looking to invest in recovery plays as this COVID-19 crisis finally ends. So I know I'm at my 5 minutes and look forward to having more and more conversation. Thank you.
Wait 1 second. So did I get this right? You could see the Dow down more than 10%, the NASDAQ down 15-ish%. I mean, just as directionally, but mid-cap value stocks could be up, perhaps even, it will hold their own, but maybe even be up. And then you're talking about recovery play. I want you to sort that out. So if the major averages are down, what is the recovery play while you're talking about the market, John? We'll get into
the one fun area, because we won't go through it all right now, I guess, but there's a lot of companies that have really struggled in this COVID environment. And my favorite example of that are the sports related companies. For the first time at Ariel, we bought pure play sports teams. Manchester United, the soccer franchise that's so well known. Madison Square Garden Sports that owns the New York Knicks and the New York Rangers. We actually own Madison Square Garden Entertainment that owns the arena. We think that those are going to do extraordinarily well as COVID disappears. We think people will not only pack the stands again, people will be coming to concerts at the Garden, and they're fun areas. Warren Buffett always says to invest in your circle of competence, and I think we all spend a lot of time following sports, going to concerts, and I think they're going to surprise people on the upside. Also, gaming revenues are going to be very, very helpful there. More and more states are legalizing online gaming, and they have to advertise and market that to the people who are part owners of sports teams. And finally, that's going to mean higher ratings for their, regional sports nets and for all of professional sports. So we're really optimistic.
And movie theaters too, I guess. I haven't been to a movie theater in forever.
Yeah, I'm not as optimistic about movie theaters just because you can replicate the experience at home. And so I do worry about that.
I guess that's interesting. Okay, and just one more thing. You said inflation could surprise to the upside. Since I want to mark you to the market next year, what does that mean? We're at 7% year over year. So what does that mean to you in terms of surprise to the upside?
I'm putting my market over 9%.
Inflation, CPI, year over year, 9%. That's what I'm forecasting. Okay, here's your invitation back next year. Okay. You've got to mark this date on your calendar for Tuesday or Thursday. It's like Tuesday or Thursday in January. Okay. John, thank you. Boy, I can't wait to get back to you where you're going to put $100,000. So you get to be more specific a little later, but I just was interested in your market analysis here. Well, now, Dr. Bob, your turn. I'm going to just do an introduction, although everybody's waiting with bated breath. Dr. Bob. Yeah, Dr. Bob is our own Renaissance man in the investment world. Dr. Bob Froehlich brings those 40 years of Wall Street experience where he's chaired investment committees and at Deutsche Bank and Hartford and Kemper funds and oh my God, 3 All-American institutional research teams, books published in, I forget, 10 different languages or something like that. We know Dr. Bob. And on the boards of, since he retired, boards of a bunch of public and private companies. I was interested also, Dr. Bob. I noticed this year spinoffs from Johns Hopkins University and IBM Watson. So, I mean, Dr. Bob's in the game, but that's not the only game Dr. Bob is in, okay? As you all know, he is the owner and CEO of the Kane County Cougars minor league baseball team. And I'll tell you something, he's guided this team for the last year and a half. I mean, where nobody could even come or reduced capacity through all the financial travails of both COVID and there was a whole league reorganization, all with his trademark optimism. So I know they're gonna play again this summer, probably with full opportunity to fill those seats. So when you're looking, all of you, for an event outside for your employees, it's a beautiful ballpark. I've been there, the King County Cougars. But now back to Dr. Bob as the investor. He's the eternal optimist. And, you know, for 5 years, Dr. Bob was giving these outrageously high forecasts, and they all came true. And last year, he told us to remember 401k. It's kind of number we all know from our retirement plans. And he called it 41,100. That was his prediction for the Dow. And the NASDAQ, of course, didn't make it to his 17,000 prediction. But he called interest rates, right, predicting them rising. And copper, his preferred investment choice, was up from 22 to about 30 before selling off recently on the index fund. Last year, Dr. Bob said that his theme was the FOGO, fear of going out, and that he was going to measure kind of what John just said recently about how people get out by his buttered popcorn index. I'm guessing that because of Delta and then Omicron, that buttered popcorn index is kind of rancid. But I can't wait to hear Dr. Bob's forecast for the year 2022. So Dr. Bob, with that as an introduction and reminding people to post your questions in the chat box. Dr. Bob, what see you for 2022?
Thanks, Terry, very much for that introduction. And it's great to be here. I'll echo what everyone said. It'd be great if we could be in person, but we're getting pretty good at this. Hopefully we can all be in person next year. Look, I've spent years as a Wall Street strategist where my job is to predict what's going to happen in the markets next week, next month, and next year. You don't survive that long on Wall Street without developing a really thick skin and also the ability to reframe issues so that the real question becomes, was he wrong or was he early? My 401k forecast of the Dow at 40,100, it wasn't wrong. It was simply early. You know, look, the long-term historic average for our stock market is around 8%. Over the last 12 months, the Dow was up over 18%. That's more than double the long-term historic average. If that's what being wrong looks like, I hope I'm wrong the rest of my life. Now, the reason I was early was because of two things that played out differently than I thought they would. First, I did not see this second wave, this Delta variant, or the third wave, the Omicron variant of the COVID pandemic, continuing to crush certain industries and destroying small businesses and in turn our economy. Last January, I thought the worst of this crisis was behind us, not in front of us. This COVID pandemic has turned into a parasite, just sucking the life out of our economy. Second, I completely miss this inflation plus supply chain upheavals equals even more inflation. While I knew we would be faced with some inflationary pressures due to the fiscal response to the COVID pandemic, I didn't see the runaway inflation coming. I have just been astounded by how every company has jumped on the bandwagon, citing supply chain upheavals as the need to dramatically raise prices to offset this global supply chain crisis. So if you think the answer to this global supply chain crisis is to simply buy American, think again. There is absolutely nowhere to hide from this inflation. Even companies that produce all their product here at home in the United States, they're dramatically raising their prices, even though they're not facing any global supply chain issues. They're jacking up prices because of the high price of gasoline is increasing their distribution costs. So they're tacking on a major fuel surcharge to offset these rising fuel costs. Now, we all need to remember this, because when fuel prices turn back around and are at historic lows again, I want you to join me in my new movement. It's called #Where's my fuel rebate? So now I've cleared the air that I wasn't wrong. I was just a little early. Let me move on to this year's forecast. Over the past 2 years, we were really hit with the perfect storm. It was a confluence of this COVID pandemic. I'll call it the worst healthcare crisis in this country in the past 100 years. Social injustice and unrest on the brink of explosion, the worst this country's seen since the early 60s, or at least the worst in the last 60 years. And finally, the most divisive, polarized political landscape maybe in the last 200 years. It would be similar to having the Ice Age, the Stone Age, and the Industrial Revolution all happening in the same 2-year period. Now, this perfect storm is creating 4 seismic shifts that are occurring right now because of the events of the past 2 years. They all have major investment implications, and they all create investment themes. Now, my first investment theme is something I call techno countries. You see, as governments around the world continue to battle the effects of COVID and social and political change, a new geopolitical player has entered the stage in the form of big technology companies. The sheer size and influence of these companies, they rival or exceed most countries. Meta or Facebook, Apple, and what do we call it, Google or Alphabet, for example, they routinely talk about having billions of active users on their programs. These companies operate in a digital space without borders, where they essentially make and enforce the rules. To understand geopolitics in the future in this world, it's going to be increasingly important to understand not just the United States and Europe and Asia, but also what are the priorities and the alignment of big tech companies. We are witnessing mega tech companies strategically align themselves either as globalists or as national champions. As our world continues to shift more into digital, techno countries are increasingly moving in as power players across the geopolitical landscape. Now, my second investment theme is something I call 24/7 checkup. With the widespread adoption of fitness trackers, smartwatches, and other wearable devices, we've never had more information at our fingertips about our daily health. We can track our steps, we can track our heart rate, our blood sugar, our blood pressure, many more vitals, and nearly in real time throughout the day. This unprecedented level of understanding about our daily activity levels and general health is leading to a boom in the connected health industry. This is making our fitness smarter and more accessible, as companies like Peloton and Nordic Track have popularized these high quality workouts right in our own homes. It's making our healthcare system smarter by providing medical and insurance providers more detailed information about patients. Look, Apple and Fitbit, for example, they've entered into partnerships with health insurance companies to share data and explore offering incentives to members. Healthcare is one of the last sectors to have been completely digitized, and as connected health devices and applications continue to explode, that transformation is closer than ever. Now, my third investment theme is something I call the big get bigger. Corporate concentration is hitting levels we haven't seen in decades. As we enter the 3rd year of dealing with the COVID pandemic, one of the early observations was that COVID was an accelerant of trends on many levels. Prior to COVID, as many industries digitized themselves, the competitive dynamics were increasingly winner take all, where the winners just they just kept getting bigger. COVID has only accelerated this trend as size and technological competence became even more important. Look, in 2020, larger companies were able to have more financial flexibility as the pandemic hit. Then in 2021, as supply chains became constrained, larger companies were also better able to manage the inventory and cost pressures associated with that. It resulted in many large companies actually strengthening their competitive position and gaining even more market share. Now, as an example of December of 2021, the current size of the top 10 companies in the S&P 500 is 30%. That's a level not seen since the dot-com bubble when it was at 27%. Size bears watching, since it's rivaling many prior peaks in the market, such as the Nifty 50 in the early 70s before that market collapsed. There have been several periods or large corporate concentration in the past. They were ultimately undone by either market corrections, economic cycles, technological change, or regulatory forces stepped in. Time will tell if COVID has structurally changed corporate concentration or if history ultimately repeats itself like it did for the dot-com bubble and the Nifty 50 bubble. My fourth and final investment theme is something I call I quit. In 2021, whether employees were fed up with having to begin that daily commute to the office again, or tired of working hard jobs for little pay, or simply using the labor shortage to find jobs that better suit their preferences, Americans quit their jobs at record rates. Workers are showing a desire for an improved work-life balance, more time for themselves and their families, and more autonomy in their daily life, not to mention the savings of time and money produced by the lack of a commute. In addition to the desire for greater autonomy, their daily routines, these workers are also struggling with childcare dilemmas, and many are taking the opportunity to retire early. More than 3 million people have retired early due to the COVID-19 crisis. Now, all these factors have led to a shortage of labor. The current shortage may have placed workers in a relatively strong bargaining position for the time being, but it's noticeable that wage growth still trails inflation. I believe companies are more likely to respond to higher wages with even more labor-saving investments. Now, in closing, remember, there's a fine line between being wrong and being early. And after all, a long-term investment is nothing more than a short-term investment that failed.
Dr. Bob, you never disappoint. I do want to tell you that one of the nicest things about all last year was that I believed so strongly in your forecast that I just felt good and happy all year long, because even if we weren't quite there yet, I always assumed we'd get there. And now this is great. So I was so entranced that I didn't fill in any of my squares yet. So give me the Dow forecast. Are we going to go for 401k this year?
You know, I don't golf, but I think they call it like a mulligan or something like that, where you get like a do-over.
Yeah,
I'm sure you do it over. Yeah, 40,100 401k. We'll get there, no problem.
Can I ask you a question, just not to forecast the NASDAQ, but because it's so tech heavy? Do you think the NASDAQ will lead or lag the Dow this year? I mean,
well, I think it will lead it. You know, I'm very bullish still on technology, and especially with the labor shortages, I think you're going to see investments in the technology area. I think the NASDAQ will cross 17,000, so I think that will make it a little bit stronger than what the Dow will be. But I think they're both going to do extremely well.
Okay, what about interest rates, the 10-year Treasury?
I hate to side completely with any of the speakers because it's nice to have differences, but I agree with Diane completely. I really think we're looking at probably about a 2.5% yield on the 10-year Treasury. It could be a tad lower than that, but if I'm picking a number, I'm picking the 2.5%, which is right what Diane picked.
Okay, and what about inflation? Where will we be in December? What will we have seen?
You know, are you giving me that 6% level to go from, higher or lower?
Over or under? Yeah, I'll give you the over.
Look, here's the thing. As I said last year, I'm a really big believer that, you know, Dr. Copper really predicts what's going to happen next. And as copper was so strong last year, and then it started turning around and weakening, I think it's a good predictor of future inflation. So I believe that the worst may be behind us. So, I don't think inflation's going down to 2%, but certainly, I think we'll be more in a 4.5% year-over-year basis, which will be well below the 6%, all because I think the demand globally for copper has turned around, and I think that's been a great predictor over the years. So we'll see if it continues to do that.
Okay. We mentioned unemployment. So, well, let's save that. Let's have a discussion. There's no point in putting a number on it because the number doesn't seem to reflect what's really going on. So I haven't asked it. But what about economic growth next year? Is there a GDP forecast? I didn't make that part of our slides this year.
Yeah, obviously, rates are still going to be relatively low. Look at 2.5% 10-year Treasury yield, even though I do think we're going to see rates back up a little. It all becomes relative. I still think there's so much pent up demand. John talked about it in the sports industry, but there's just pent up demand for people wanting to get out and go to restaurants and live their life. And with this 2 years worth of pent up demand, I actually think the economy is going to surprise on the high side. When I say high side, above trend growth. So I'm looking for maybe under 4, but over 3.5. So that would be very bullish for our market, which is why my forecast is pretty bullish for a Dow and a NASDAQ.
I don't know about everybody else out there, but I'm kind of heaving a sigh of relief. Can we see if we can get the Hollywood squares back up on the screen? But I'm going to ask you, Diane, I only seem to hear whoever's speaking. Diane, let me start out with you on this jobs thing and go back to Dr. Bob for a minute. What happens to jobs in America in the year ahead? 2 years ago, you pointed out we had an increasing divide. Are restaurants going to get servers back? Is that going to crimp the economy, especially the service sector? What Dr. Bob's talking about?
I think actually Dr. Bob makes a really good point in the concentration that we've seen. The pandemic has accelerated employment at large retail behemoths that are online superstars, Walmart and Amazon, to name a few. And that's really important because they're setting the floor on wages. And what we've seen is, interestingly, that not only are they setting the floor on wages, they also have the technology to absorb the shock much better that Dr. Bob talks about than small and mid-sized businesses. Manufacturers now are seeing their quit rates pick up after years of not seeing quit rates. We've always had high turnover in these low-wage sectors, but we haven't seen the turnover like we do in places like manufacturing. But that's more a testimony to the fact that they're competing with these low-wage jobs because wages in the manufacturing sector, it's more a testimony to how low they had gone rather than how high they have remained. And I think that's really important. In terms of the overall labor market, we'll cross the previous peak. It's interesting, the Fed has decided that we are at full employment despite the fact we've not crossed the previous peak of February 2020 in employment. We're still more than 3 million jobs down from that previous peak. What we saw in December was, and really from October through December, was finally people getting their boosters, and some of that over 65 crowd that couldn't afford to stay retired, they started to come back into the labor market. The wealthier retirees that could afford to stay on the sidelines, they're still there. But I think the important thing to think about is, what is our supply of labor? We lost between 2016 and 2019 immigration, mostly legal immigration, which is the primary offset to the aging demographics we have and growth in the prime age labor force. Legal immigration fell 40% from 2016 to 2019. It fell down another double-digit rate in 2020. We don't have the numbers for 2021, but it looks like that trend accelerated, and we're running about 1/10 of what we need in immigration alone, mostly legal, just to be able to keep our labor force growing. So that's one issue. We also have out there the long haul COVID, which is affecting disproportionately, also deaths have disproportionately affected many of those low wage sectors. And so it's not all that surprising that that's where some of the upward pressure on wages has become. Whether or not those wage gains get entrenched, what the Fed is worried about excuse me, is that 7% CPI, does that get priced into wages as a cost of living adjustment like it did in the 1970s. In the 1970s, 80% of all wages in the US economy were tied to a COLA,
Yeah.
a cost of living adjustment that was indexed to the CPI. It takes a big leap to get from here to there, especially given the concentration in firms that don't have a history with unionization. So I don't see that happening, but I see the risk there because we're at such a huge gap. By the end of December, Indeed.com, the job posting site, my friends over there, they think it's 12 million job openings at the end of December, with about a little over 6 million people looking for a job. And that's before you even start dealing with, matching competencies. And some of the algorithms are really bad, frankly, at casting a net in terms of finding the right people for a job. And some people can't even apply online because they're in dead zones. But I think these are important things to think about.
Okay, your daughter's going to be in the job market one of these days. I always think of her as being 12. She must be in college now.
She's in graduate school now. She's not going to be there for a long time to come.
Oh, okay. But if you're advising a young person in their 20s or 30s about jobs now, do you demand? Can you go to another company or demand from the company that's recruiting you? Can you demand a higher salary? Are you in really that good a position, or is that turning now?
No, you are in that good a position, especially if you're Gen Z. Especially if you're Gen Z, which is the most recent graduates, those that are 23 and under, and I think that's really important to understand.
They're going to be
we do have a shortage, and they've got a lot of market power right now, and seize the day. I mean, after millennials took it on the chin during the global financial crisis and got set back and getting crowded out of the housing market. I know we're going to talk about that as well. Getting crowded out of the housing market. That is now they're finally getting crowded out by investors flipping to rent instead of sell, and the investors are buying sight unseen.
I got 5 questions about housing, but I want to go back to stocks for a second. And I've got a couple of questions. And John, one obviously directed to you. Would you be investing in travel stocks right now as part of this? There's a couple of questions. I'm just going to throw these out at you, John. Will the tech stocks bounce from here? This is reference my Kathy Woods remark. She thinks that this is a long-term thing and this is probably a good time to buy, and her people are sticking with her. So I've got questions on travel stocks, tech stocks, and the PE ratio of the S&P 500. Someone says notes is approaching the 2008 levels, which triggered declines. The question is this the worst time to buy stocks? John, why don't give us a little tour of the stock market, particularly start with travel. Is that part of I don't go to the movies, but what about the airlines and hotels and vacations? What do you think about those?
I think the airlines have always been, as have been one of the worst industries to invest in, throughout history. They have their booms, they have their busts. There's always a problem, energy prices, et cetera. So I would continue to worry. I know some of the boards that I'm on are saying they're going to go and if they have 5 meetings a year, maybe they'll have 1 or 2 a year by Zoom, have their committee meetings by Zoom. I know again, for the corporate board or nonprofit, everyone's using technology. And so I think business travel is going to be substantially, permanently changed by what we've learned through COVID and Zoom. So I'd be cautious around the airlines, cautious around the business hotels. I think the fun leisure places will still be there. As I think it was said earlier by the doctor, people, there's a lot of pent up demand, and I think people will want to go on cruise ships. And so we own Royal Caribbean, we own Carnival, we own a company called One Spa that does the spa treatments on the cruise lines. I think people are going to want to have those kind of vacations to get back on track, and people will travel that way. So I'd, again, avoid hotels, avoid airlines, but I wouldn't be afraid of some of the leisure-oriented types of companies that are out there.
I'm writing that down for next year, John, because you couldn't pay me to go on a cruise right now. Right? Okay, so are you a contrarian by nature, or are you just ahead of the curve, or what?
I've always been a contrarian. I think, growing up an only child in Hyde Park, part of the University of Chicago community that we all love. And I think we learned to think independently. And I've been fortunate, right. A lot of independent thinkers in my life.
Okay, comment on tech stocks. That was something else someone wanted me to ask you.
Yeah, I think it's something, it does remind me, as I said earlier, of what happened when the internet bubble was booming. everywhere you went, people were telling you how much money they made in their tech stocks, and just this most recent period, whether it's the pizza guy that delivers my pizzas when I order, and they all have their hot stocks that they want to talk about. And those are always signs that you're getting to a top. We saw what happened with the meme stocks that you touched on earlier. We saw with Robinhood and all the hoopla around that. So I just think that once everyone's decided they can get rich chasing technology stocks, I think it's going to be very, very difficult. Now, there will be winners in the long run. As we know from 20 years ago, when the internet bubble burst, some companies still did extraordinarily well. We saw what happened with Amazon and Apple and others. So there will be those unicorns that explode and do better than expected. But the broad cross-section of them there's going to be a lot of difficulties. And so many companies, the last thing, they went public. You had the SPACs, all this kind of rush to take advantage of all this euphoria, which is a sign that you're topping.
Dr. Bob, wait, I want to take you back because of what you said. The first thing was big techno countries, kind of like companies or countries. Even with that picture of your belief in the future for the power of tech companies, do you want to comment on the pricing levels right now? They've come off quite a bit in the last 2 months.
There's some that are decent value, or some, as John said, that clearly are at all-time highs and pressing that valuation play. So, I think what I would say is I agree with John completely in that there's going to be winners and there's going to be losers. I don't think it's the whole technology sector is going to take a run, but where I get my bullishness for tech and for the future is who's going to replace all these employees we can't find? It's going to be technology. Who's going to replace all the meetings that we don't go to anymore in person? It's going to be technology. I think the world has changed so dramatically that we don't want to accept the dramatic nature of this change, and that is it's never going back to the way it was. Boards are never going back to the way they used to operate. Employees are never going to have to go back to working in the office 5 days. All that stuff, when you put it together, it has a theme of technology as the underpinning that's going to make that work. Now, it doesn't mean that every technology company that wants to launch some video conferencing is going to be successful, but I think the fundamentals of what has happened to our labor market and the future of travel, I agree with John completely on that. I think business travel is going to continue to take a big hit, which concerns me about commercial real estate, concerns me about, hospitality. I think there's a lot of spinoff, but boy, the underpinning, I just think, I never thought I'd live long enough to say this. I think technology is touching more things, not less things. And I see that trend continuing. You just need to have a great stock picker like John pick the right companies.
So you'd both be right. Okay, Diane, I'm going to hold off for a minute. I want to go back to real estate because I have a bunch of questions, but I also have some questions about something else in the investment area, which I'd like all three of you to comment. A couple of people have, I came up with a question I wanted to ask that's in this area of interest rates. If none of you think, or if you all agree that even at the most inflation that you're predicting, that you're going to have the 10-year treasury around 2.5%. And we've got some predictions of inflation could be 5, 6, 7, 9%. So people who hold cash are sure losers, although they think they need liquidity. And people who own bonds run the risk of losses because who wants to have an only, 1.9% US Treasury if rates are going to go higher? Does that mean there's a thing going around, Tina, there is no alternative for the stock market? Where do you see this balance? A lot of people are saying, what do I do with the bonds? How should I balance? Which is better in my portfolio, short-term bonds or cash? Could you just talk about these trade-offs from a personal finance point of view as well as an investment point of view? Who wants to start it? John, go.
I'll start, and I mentioned Warren Buffett earlier, and he's been really clear at the annual meetings and in his annual report that the bonds are the worst place to be. That it's basically going to be a loser's game with these higher interest rates, there's just no way that you're going to be able to do well in bonds. So it's hard to go against the Oracle of Omaha, and I think such an extraordinary investor. So I think cash is the place to be. You're going to have, a significant portion of your portfolio in cash and ready to move it into the markets as the stock market ultimately has difficult periods and difficult times and sectors get hurt. You can move in dollar cost average. The last thing I would say is buy blue chip companies that have some portion of your portfolio, blue chip companies that have a healthy dividend. There are a lot of great businesses out there that pay dividends for 100 years or 50 years and raised it every year. That's another way to get income, have some, stock market risk, but the blue chips will stay solid over the long run.
Diane, any thoughts about this terrible problem that ordinary investors have? We want to have pros like John manage our funds, but what do you say to people when you say you don't want them all in the stock market? Bonds are a sure loser. What about cash? Money market funds, are those rates going to go up?
One of the things I think is most important in this, and I do it from the perspective of an economist, and that is the theme of the Jackson Hole, Wyoming meetings from the Federal Reserve. One of the biggest echoes of that, and is sort of still echoing in my ears and makes me worried about where we are, is the reach for yield that we've already seen in a zero interest rate environment, and the risk taking that continues to spur. And what it's done is the divide between the developing world and the developed world has grown wider. The haves and the have-nots. Decades we had the developing world catching up with the developed world. That is now broken down. China likely will flatline this year. They won't print a flatline in growth, but they're not doing well. They already contracted, it looks like, in the fourth quarter. And not having the developing world performing as well, and the fact that they took on massive amounts of debt, and they've got to match even small increases in interest rates with increases in interest rates at home in order to counteract the effect on their currencies and inflation at home. You've got stagflation, a real mess in Turkey, but you've got inflation everywhere, even where economies are stagnating. Not in the United States, it's off of a boom, but that sort of ripple effect, I worry about the spillover effects. There is no Las Vegas in the global economy. And what I worry about the most in 2022 and 2023 is that we have a default. Almost all the debt in developing economies is held on the commercial bank balance sheets of that country. That's a doom loop. That is really bad. That's worse than the Thai baht crisis and the Russian debt debacle crisis of 1997 and 1998, which I do remember because we were all here because we're getting an older panel now. But I think it's important to understand that because that's what the Fed is risking. And the volatility that we're likely to see this year, it is a time when you do want to be more in cash because of that volatility. In my own personal investments, I have a hedge fund I'm invested in that really does hedge volatility. When the market is more volatile, I do better in it. And I have a portion of my portfolio in that. And that is something that I think is really important to understand, is that this is going to be a rocky year. The Fed hasn't chased inflation since the 1980s. And the risk of a misstep is huge. And the misstep isn't just in the United States. It's how it could come back and wash up on our own shores.
Hey, Terry, let me add one thing to this. When I started in the business, asset allocation was a pretty standard, easy answer. The answer was 60-40, 60% in stocks, 40% in bonds. My answer is still 60-40, although what you're investing in is differently. I'd still have that 60% in stocks, but I would have the 40% in alternative investment. I wouldn't have anything in cash. You're going to lose money. I wouldn't have anything in bonds. You're going to lose money. I want to invest in things that I'm going to make money on. Now, in the alternative investment, certainly, as I mentioned before, I wouldn't be in commercial real estate, but there's a lot of other real estate investment trusts out there that are focused on industrial real estate. They're focused on single family house. So there's ways to make money and augment that income. And also in the alternative space, I think there's some commodity plays that are out there, a lot of commodity products. So to me, I don't want to invest in something that's going to lose money. I think cash is going to lose. I think bonds are going to lose. I think the only place to make money is in the stock market and in alternatives. And that's where I would be, basically 60-40 with that 40% in real estate / commodities in the alternative space.
We're going to come back in a minute and get specifics, but I promised that I would talk about real estate. So because, and then I mean, that's been an incredible sector this year. I would go back to Diane just for a moment before I come back and ask you a couple more questions and are what you do with $100,000, although I'm getting a lot of good hints. So Diane, we've had an, housing market. You called this last year, that was where you want single family homes. And boy, those prices, we've never seen an increase. Rising rates, impacting mortgage rates, shortages, inability to finish homes because windows aren't there or whatever it is. What happens to real estate prices this year, particularly on the residential, but everybody could talk commercial too?
Yeah, I'm really, really worried about the upward pressure on the residential market not abating enough, because the more we go, the more frothy it looks. And the role that investors are playing, large cash buyers, buying properties sight unseen in rural areas that don't have broadband, to play off the idea that people are going to move there in order to do work from anywhere. I think those are things that, to me, are big warning flags. And I am very worried now that although we may or may not be in a housing bubble yet, we are getting close. The good news is, we've got a lot more equity in our homes and a lot more cushion. And we all know that, you never say that. Actually, someone say to me recently, well, housing prices never fall. And I'm like, where were you in 2007 and 2008 and the last decade? But anyways, I think it's really important to understand that we're getting into a very precarious place. I fear that housing prices will continue at a fairly rapid clip and then slow as we get into the end of the year. The legacy effect of people rent moratoriums and the rents that are going up, all those things are going to be pushing up shelter costs. That's a part of inflation that will be much hotter by the end of the year in 2022. But I do worry about how high they go and sustain even as rates go up. We have seen already big movements in mortgage rates and applications have pulled back, but we have such huge demand still. It's that mismatch between this collision of the mismatch between heightened demand and inability to finish projects, and construction workers also among the least vaccinated. And that's fine if you're working outside. It's not if you're doing internal finish work. And that could set us back again in terms of being able to deal with the demand and providing more shortages out there. So I really do worry about that. And this is an aside, but lumber prices are back up again, and lumber got hit, manufacturing got hit during the Delta wave because so many people perished on lumber factories, in lumber processing plants in the South during the Delta wave.
Now, if anybody has anything burning to say about housing, you always cover that so well. I want to hit one more topic before our what you would buy thing, because we haven't talked at all about politics. We haven't talked about, given the current circumstances, and I'm not asking to do a political discussion here, but given what's going on in Washington, last year there was a lot of concern about tax law changes. There's another, the Build Back Better plan, which is we've had the infrastructure bill, which it passed and nobody's talked about where's the money, where's it going, that I know of. Now there was this push, now it's moved on to voting rights. But what do you see the impact of politics and the fact that this is an election year having on the markets and rates and what comes out of Washington and tax law? A quickie from each of you. John, let me start with you. What could come out of Washington in terms of tax law?
I think very little. If we talk to our economists and talk to our tax experts and others, we just think in this kind of an environment with the kind of turmoil we have, there will be no significant changes in our tax law.
Okay, Diane, you're close to Washington. What do you see about that?
Yeah, I never underestimate the incentives in an election year, and stimulus checks are really popular, but I don't see anything. In fact, I said very pointedly, I'm the epitome of Build Back Better and the only one you're going to see this year because this is it. I don't think it's going to happen. Although on the infrastructure, I will note, infrastructure projects take a long time to get up and running, and the biggest impacts of the infrastructure infrastructure bills don't really kick in until we get into 2024, 2025. And that's really important to remember in terms of sort of sequencing. Right now, actually, the federal government is a headwind for fiscal policy. State and local governments actually have a lot of cash and they've yet to spend it, but if they were to spend it, that's where the stimulus would come from.
We'll talk about Illinois in a moment. No, I'm not going to go there because I don't have enough time. Dr. Bob.
Actually, we do actually. Even Illinois has money. Even Illinois has money.
Well, pay
Believe
down
it or
some
not, even Illinois, because tax revenues went up, and also there were some transfers, but most of it was tax revenues. We bought a lot of stuff, and it's all taxed at a pretty high rate in Illinois.
Well, good. Pay down some pension obligations. Dr. Bob, anything out of DC that's on the horizon this year that would markets or the economy that you see?
I really don't see it. I mean, I really do. I agree with what Diane said, what John has said. You know, I think gridlock, you know, look, the thing with gridlock is it means that some good things won't happen. But the better thing with gridlock, it means that they can't do anything bad. And so I like the fact that they can't hurt us. So I'm not worried about being helped, just don't hurt us. So I think actually gridlock can be good for the market.
All right, we're running out of time. So this is the one thing that everybody sticks around for, and let's do it in the next 3 minutes, a minute apiece. Dr. Bob, where are you going to put your $100,000?
I'm going to put it in my 4 investment themes. So remember, my first investment theme was that techno country. So I'm going to take 25,000 and put it in Facebook or Meta or whatever they call themselves this week. That ticker symbol is FB. It's currently trading at like $334 a share. Second investment theme was the 24/7 checkup. I'm going to invest 25,000 in United Health Group. That ticker is UNH, currently trading at like $470 a share. Third investment theme, the big get bigger. I'd take 25,000 and invest in Amazon. That ticker is AMZN, trading at an unbelievable $3,295 a share. And fourth investment theme called I Quit. I take the final 25,000. I would invest it in iRobot. That ticker is IRBT, trading at $68 a share.
Well, you're so wonderful. You're so specific. Okay. Well, God willing, we'll all be together next year. We'll get the answer. Diane, what are you going to give us? Come on, give us something special. Specific, I mean.
Well, I am invested in a hedge fund that really does hedge volatility, because I think it's going to be a really volatile year, speaking to John's concerns. And so that does well when it's really volatile. So however we get to the end of the year, I think it's going to be a rocky road. So at least half of it in that. Also, I would be investing in the biggest threat to the US economy and the global economy is climate change. And clean energy, electrical vehicles, not just Tesla, broadened out. Demand for electric vehicles is skyrocketing. It's really been amazing to see what's moving on the domestic front in the vehicle sector. And that's where I would put another one of my bets. And I think that's really important. And the last part is in a part of something that, echoing something Dr. Bob said, and that is not all real estate is bad, even with interest rates going up. And in fact, in real estate, most notably that stuff that's being done in the industrial sector to do warehousing and distribution, that real estate is still very, very hot. And I think there's still a lot of opportunity there as well.
Okay. I just want to go back to your thing about volatility.
Do online shopping.
Okay. Volatility.
Pardon me?
Volatility.
Yeah, the VIX.
Explain how the ordinary you're
hedge
hedging
against
volatility. How, but in a hedge fund, but how do real people, is there a way that you can hedge against, beside the VIX, trading the VIX? Is there a way ordinary people can do that?
I can't say any specific fund, but there are funds that are hedge funds that are really hedge funds.
Okay,
I'll let John pick that up.
Well, this is what I mean. I talk about saving. I'm going to actually start a new part of my chart here. I'm going to take a whole new sheet of paper. John, we're so glad to have you because we know this is your area of expertise. So if I gave you $100,000, I don't have student loans, I don't have credit card debt or a mortgage to pay off. Want to invest not just for this year, but for the long run. But we're going to mark you to the market at the end of this year. Where you put $100,000?
What I would do is I would put, I'd start by putting $50,000 into the market, and I'll give you the specifics. I'd save $50,000 that I would invest throughout the year, dollar cost average. So put $5,000 a month for the next 10 months, and then you put that with the other $50,000 and you would be completely invested by the end of the year. The areas that I would focus on that I think are cheap, the financial services sector, we still think are cheap. There are some great companies there. I don't have time to get into details, but Lazard, investment banker, our hometown Northern Trust, the Bank of Oklahoma with my favorite financials, Housing related, I like the companies that supply sort of the modern home automation solutions. So companies like Resideo that make thermostats, ADT, the security firm, Mohawk that manufactures carpeting. And I mentioned already the sports related companies that we love, Madison Square Garden Entertainment and Madison Square Garden Sports. And then finally, in the media space, I love the media space. And so that's one of the benefits of all this challenge in Washington. People are spending more money advertising on television and political races. So companies like Tegna, Viacom, CBS, and of course Nielsen that keeps track of all the eyeballs that watch television. So those would be my favorite areas to invest.
I have an interesting question for you, John. Those are all in the Ariel flagship fund, pretty much?
Yes. Yeah.
Okay. Then why wouldn't you just start dollar cost averaging into the Ariel flagship fund? It would make it so much easier.
Well, that's where I have my own money, and my daughter's money, but I just didn't think that was appropriate in this setting.
It's very appropriate. That's why we have you here, as a matter of fact. One of our great investment gurus of Chicago. And of course, he can't say it. You have to read the prospectus first. But if you wanted to take all the stocks and not have to deal with them yourself, it's called the Ariel Flagship Fund. I want to say thank you, first of all, to our audience who comes back every year. We hope we've served you up some interesting ideas. We have the best panelists of any economic forecast ever, and I really thank all of you for coming back. Diane, we wish you especially another year of good and better health, and all of you out there to stay safe and stay healthy. And thanks very much to the Executives Club, the organization. Go to executivesclub.org, look at the upcoming programs. Our sponsor, BMO Harris, thank you so much for doing this for us every year. And also all those other companies that ordinarily you'd see signs on the tables, but they contribute also to make this program work, and others for the Executives Club. So with a giant thank you to all of you and a heartfelt wish that we can come back next year at this time so I can use all these notes. Thank you and have a wonderful year ahead.